Okay. Good evening, all of you. So today I'll be discussing the pre-September mock 2024. Okay. Now, in this session, I will not be discussing section A and section B because I believe that you can do the self-evaluation on the ACCA practice platform. So when you solve and do the self-marking, so ACCA platform itself guides you on which answer is correct and which answer is incorrect and what's the logic of being incorrect. Okay, so that you can review on your own and there is no need for me to help you out on the same. But yes, definitely there is an area where you struggle the most, that is the section C of the exam. So today I'm here to discuss with you section C of the pre-September 2024 mock examinations. So section C, as you know, is comprising of two questions. One will be from preparation of financial statements and the another will be from interpretation of financial statements. So let us discuss one by one. So this is the first question. As you know, as you can see here, it is FR pre-September 2024 mock exam. If you can see it here. Now, this is the first question of section C. It says this scenario relates to two requirements. On 1st April 20x8, Pleasant Company acquired 85% equity share capital of a Roses Company. Pleasant Company also owned 35% of Daisy Company since 1st June 20x7. In my revision sessions and everywhere, I have told multiple times that console P&L, group P&L is the favorite area of the examining team. And now here you see, again comes a question on console P&L, group P&L. So my words are getting correct again and again, that group P&L is a very, very, very much favorite topic of the examiner. So you can't afford to leave this topic. So please keep it as a priority and do solve it. And now one more thing. Uh, if you have watched my video on the list of important questions for FR, in that question, I recommended you a question on Pandar company, right? Have you solved that question? Tell me. Come on, guys, tell me. If you have not watched that video so far, please go and watch it off, okay? If you have already watched it and then also you have not solved it, then please go and solve it. If you have already solved that question, then you will see a similarity from that question in this question. You will find a similarity. And you won't be able to solve this question if you have not solved Pandar company. Okay, or a similar question. Now, so when a question comes on group P&L, tell me what is that we have to first identify. So we need to identify what is the date of acquisition, okay, and what is the reporting date, what is the percentage that we have acquired. Now, in this question, we need to understand that on 1st April 2008, Pleasant Company acquires 85% of Roses, meaning thereby a subsidiary, okay. By default, we understand that if the voting rights, if the percentage stake that we have acquired is more than 50%, it is control exists and it is a subsidiary. And if it is 20% or more, it is significant influence and it's an associate. So it says that 35% of Daisy company is acquired on 1st June 2007, which makes it an associate. So basically, Pleasant Company is the parent company, Roses company is a subsidiary company, and Daisy company is a associate company. Now, one more thing, the reporting date is 31st December 2008. The reporting date is 31st December 2008, meaning thereby we have acquired subsidiary company in the mid of the year. So when you are preparing group P&L, tell me what is the thing that we need to be careful about? When the subsidiary company is acquired in the mid of the year, what is that? We have to be careful. Time adjustment. Very good, Mehak. Very good, Mehak. We need to be careful about the time adjustment thing. Now, Daisy company was acquired in the previous year, so no need of time adjustment. Now, let's read the question further. So it gives you the P&L for the entire year for the parent, for the subsidiary, and for the associate. Now, tell me, what will be the P&L structure? So P&L structure will be the entire P&L of Pleasant, the entire P&L of Roses, but after time adjustment multiplied by 9 by 12. Okay. But for Daisy company being an associate, will we do line by line addition? For Daisy company being an associate, will we do line by line? No, we will just give a single line item stating share of profit from associate Daisy company. Now, moving further, though I will solve the entire question, but first of all, I'm giving you a brief about the question so that you need to understand how exactly are you required to read the question in the exam. Once you know how to read the question in the exam, definitely you can deal any question in the exam. Okay. So let us first understand what exactly or how exactly you need to read and interpret the question in the exam. Is my audio proper, guys? Come on. Can you please confirm? Is the sound clear? Very good. Very good. Now in P&L, you see revenue, cost of sales, gross profit, distribution cost, admin expense, investment income, finance cost. Now, again, I have told something about finance cost. If you are able to understand, if you know, you know. Now, definitely I'll discuss about that. Profit before tax, income tax expense, profit for the year. Then comes other comprehensive income, gain on revaluation of land, total comprehensive income. Okay, now comes the adjustments. So what are the following adjustments? Just read. A fair value exercise conducted on 1st April 2008 concluded that the carrying value amount of the Roses company's net assets were equal to the fair value. So it says the carrying amount is equal to the fair value with the exception. So what does it represent? Basically, it means that on date of acquisition, parent company, that is Pleasant company, is required to acquire the net assets of Roses company, that is subsidiary, at its fair value on date of acquisition. Now it is saying the carrying amount is the fair value with an exception of machinery, which had a fair value of 10 million in excess of its carrying amount. So we need to account for it. We need to account for it. We need to account for it. Okay. Now, so what I'll do is I will write here adjustments. Adjustment number 1. So definitely, first of all, you have to draw the performer, but I haven't drawn the performer first of all. So I am treating the adjustments and then we can draw the performer and prepare the console P&L. So let us write the adjustments. Number 1, fair value adjustment. Though we have read the requirement and we know that we need to prepare console P&L and other comprehensive income. Okay, console P&L and other comprehensive income is what we are required to prepare. Now, moving on to the next question, the adjustment number 1. Okay, so it says the fair value adjustment on date of acquisition is what? 10 million. So I'm writing all the amounts in thousands, all the amount in thousands. So that's what P&L is. That's how P&L is prepared. Thousands, amount in thousands, right? So we will also prepare P&L in thousands. So it will be 10,000. And now, so let us format it a little bit. Okay. Now, what is the remaining life? At 1st April 20X8, that is the date of acquisition, the machinery had a remaining life of 5 years. So now, so this is the fair value adjustment on date of acquisition, which will be used for calculation of goodwill, on date of acquisition. Basically, it will increase the fair value of net assets, which will be used to calculate the goodwill on date of acquisition, goodwill or gain on bargain purchase. Now, this is a fair value. Now, this has a remaining life. This has a remaining life of how many years? 5 years. Guys, I am trying to be as detailed as possible, but in the exam, are you required to write this remaining life and something of this sort? No, not required, not required. You can just directly do it off that. You can just directly do it off. Okay. So now excess depreciation. I am doing it in a detailed manner so that if you are understanding this question, okay, let us give you a detailed understanding of the same. Okay. Now, excess depreciation. Excess depreciation. So what is excess depreciation? So it will be equals to 10,000 divided by 5 years multiplied by 9 by 12. Are you required to show it this way? Yes, this is how you are required to say. Why? Because if you do it this way, even if you make a mistake, examiner will get to know, okay, this is where you have made a mistake, and you will score the marks in under the own figure rule. You will score the marks under the own figure rule. So this is how you, this is the exercise representation which you have to write. Okay, now what is the, okay, now this is what it is. Further, adjustment number one as sorted. Adjustment number two, since acquisition, adjustment number two, it is about intra-group trading. Adjustment number two is about intra-group trading. Fine. So it says Pleasant company has sold. So parent has sold the goods to subsidiary totaling to 25 million. So it right here, intra-group trading, Pleasant parent to subsidiary, P to S, Pleasant to subsidiary. Okay. Now, what is the intra-group trading that is done? What is the intra-group trading? That is 25,000. Now, so definitely, what is the treatment of this intra-group trading in the console P&L? We reduce it from the revenue and from the cost of sales both. Okay. Now, apart from that, we also calculate the unrealized profit on the unsold goods. On the unsold goods. Guys, one more thing, if you have not watched the revision video, okay, so basically in the revision video, I have covered the entire ACCA FR syllabus in just 8 hours. So do watch it, make use of it. It is there in my YouTube channel. So go and watch it and make optimum use of it. Okay, so you will get to revise the entire FR, the every minute details of it in just 8 hours. Now, intragroup trading is this much. Now it says what? Rose's company had 1/4 of these goods in inventory. So what is the unsold? What is the unsold goods? So unsold goods is 1/4. That is 1/4. Unsold is 1/4. 1/4 of 25,000. So that comes to this by 4. Now what is the markup? What is the markup? Markup of 35%. Now markup on cost of 35%. Are you able to understand the meaning? Markup on cost. Markup on cost. So unrealized profit will be equals to how much? This multiplied by 35 divided by 100 or 135. Tell me. Divided by what? 135. Very good. Very good. Very good. Very good. So this we will add to the cost of sales. This unrealized profit will be added to the cost of sales. Now, further it says during the year, Pleasant has also sold the goods to Daisy. So parent to associate. Parent to associate. Now, what is the amount of unrealized profit? So unrealized profit is how much is sold? 26 million is sold. So unrealized profit is how much? 26,000 multiplied by what is the unsold inventory? All of which is in the inventory. Oh my God, 2045 by 135 multiplied by what is the in associate percentage? 35 percentage. 35 percentage. Copy. This is the unrealized profit on inventory. I believe it is very much sorted to everyone till here. I believe it is very much clear to everyone till here. Okay, good. Adjustment number 3 is investment income. The investment income of Pleasant Company for the year in 31st December 2008 includes dividend from Roses and Daisy. See note 4. It also includes, and this is the part which makes it similar to Pandar Company. Why we done 35% as we done 35 by 135? So 35 by 135 is for markup. 35% is for the 35% is for the parent share, because this is what is the percentage of stake held by a parent in Daisy company. Okay, Akshat? Because in the case of associate, we take our share of unrealized profit. Unfortunately, the percentage is same. So that's why you got confused, but no issues. So this interest receivable will deal. Okay. So it's a intra-group loan, which will deal. No worries. Adjustment number 3, then you can write here. Adjustment number 3, we are skipping now. Adjustment number 4, dividend. Dividends. Now, Rose's company has paid a dividend to the shareholders of 13 million. Okay. Dividend paid by Roses, that is subsidiary. Dividend by Roses, that is subsidiary. Subsidiary, not subsi. How much? 13 million. But how much of it is, how much of 13 million is received by parent company? The entire of it, right? The entire 13,000 received by the parent company? No, the 85%, right? Received by parent, that is Pleasant, pleasant, is how much? 85%. Is equals to 13,000 multiplied by 85%. That comes to this much. Now, received by NCI is how much? This multiplied by 0.15. I don't know where this information will be required, but might be in some other places it might be required. Now, all other items in the statement of P&L and other comprehensive income are deemed to accrue evenly over the year. Now, this indicates that now is the time that we should focus on preparation of the group P&L. Group PL. Okay. Group P&L for the year ended 31 December X7. Okay, now fine. Let us prepare the group P&L and OCI. So this is for the PLEASANT Pleasant. This is for, you can say, what is the name? What is the name? Roses, right? Roses. And this is for Daisy, DAISY. But do we need a Daisy company here? Do we need Daisy company here? We don't need. So let's delete it off. So now what we'll do is we have to do the time adjustment. So do not forget to do the time adjustment. Okay. Now then we have to make some adjustments. We have to make some adjustments, and then we will see the group P&L. But just to highlight to the examiner that this is the correct final answer. So what we'll do is we will color it off. Uh, Ideally, yes, Veda, but might be you might face some other technical issue, technical glitch in the exam, and you might not be able to do. So if you are able to do, very good. If not, then you are bad luck. Ideally, yes, but ideally, yes, you can do it. In my opinion, because if you are able to do it here, and ACCA claims that this is a similar platform as what you will get in the exam, then definitely you should. Now, tell me, so what are we going to do now? First, one by one, we'll do everything. Okay, now, first, out of fair value adjustment, are we required to adjust fair value in here? No, we are required to do the fair value adjustment, excess depreciation on fair value adjustment, add to the cost of sales. So let's add. Be very careful about the sign, guys. All the expense are in negative. So if you have to increase the expense, give a negative sign. If you have to decrease the expense, give a positive sign. Be very careful. Be very careful. So now we have to add this excess depreciation, meaning thereby we have to increase the cost of sales. So we'll give a negative sign, minus 500 A1. minus 1500 A1. So this completes our this adjustment. Tell me yes or no. Adjustment number 1 sorted. Now coming on to adjustment number 2, 25 million is the sales intragroup trading. So first of all, we'll do minus 2500 25,000 A2, and similar adjustment will be done here as well. Similar adjustment will be done here as well, but here we will write a plus sign, and I believe you know why. And I believe you know why. Very good. Now the third thing which will come up here is unrealized profit. And what is the unrealized profit for parent to subsidiary? 1620, 1620. So let's add, let's increase the cost of sales, meaning thereby minus sign 1620A2, unrealized profit. Now this is also done, sorted. Now, during the year, Pleasant has sold the goods to Daisy. So now there is an unrealized profit. There is an unrealized profit from the Daisy company as well. Now tell me, who has earned the profit? Pleasant company. Pleasant company. So where shall we adjust? In the cost of sales. Ideally in the cost of sales. But in some areas we see, see that it is also adjusted as a part of the share of profit of the associate. Okay. But if you go correctly, this is where you should adjust. Okay, so minus 2359 A2 unrealized profit. I believe it is very much clear to all of you. This is also sorted. Now, so adjustment number 1 and adjustment number 2 is sorted. I believe no one has any query. Adjustment number 3, I have parked for towards the end. We'll discuss towards the end. Now, coming to adjustment number 4, Rose's company has paid a dividend to the shareholders. Now, how much of this dividend is received by the parent company? We calculated it 11050. Yeah, 11050. So we will reduce investment income. So what we'll do, minus 11050 comes from A4. Okay, and rest all done. Daisy company has paid a dividend, so that is coming as part of share of profit. So this we have left now. This also is remaining as of now. Okay, the treatment of Daisy company is remaining, and the treatment of this one is remaining. Okay, so these are the two treatments which is still pending to be discussed. But rest everything, is that clear, everyone? Rest everything, is it clear, everyone? Tell me, guys, come on. Now, can we prepare the group P&L on the basis of this one? Can we prepare group P&L on the basis of this one? Is the screen properly visible or the font is small? Are you finding the font is small or it is fine? Okay, fine. Because I have decreased the font a little bit now. So let us first of all prepare the group P&L using this data, and then we will discuss the two treatment, the share of profit of associate and the this one, the finance cost part. So let us do that. So it is equals to this plus this into 9 by 12 minus 25,000. Similarly, this plus this minus 1500 plus 25,000 minus 169. This plus 25 into 9 by 12. Okay, minus 1500 plus 25,000. Okay, minus 1620 minus 2359 is 549479. So this comes to this sum. Then this is equals to this plus this multiplied by 9 by 12 equals to this plus this multiplied by 9 by 12. Similarly, finance cost is equals to this plus this into 9 by 12. But we have to make an adjustment here. We have to an additional adjustment, that is minus 11050 is an additional adjustment. Similarly with the finance cost, but you will see that we will have another adjustment in the finance cost. So we'll rediscuss this part, but no worries. First of all, let us do it off. Revaluation gain is for the this OCI part is for the parent fully. So no, nothing done some sorted. Now we will have to show the allocation of profits. We have to show the allocation of profits. Okay, to NCI, to be owners of the parent, owners of parent, and NCI. So now let us first of all calculate for NCI, and then we will do the rest of the things. Okay, first of all, let's do the for NCI, and then owners of the parent will be the balancing figure. So what is the allocation of profits to NCI? Allocation of profits to NCI. What is the sorry, my bad. Okay, bold. Now, so what is the post acquisition profit of post acquisition profit of this one roses? So it is equals to what is amount roses is 283,450 multiplied by 9 by 12. Now, out of the adjustment that we have made, which adjustment you believe impacts the profitability of the roses company, impacts the profitability of the roses? Now, adjustment number one, excess depreciation. Yes, excess depreciation. Definitely it impacts. So what is the amount? 1500 in my opinion, right? 1500 is the amount, right? Can anyone please confirm? Can anyone please confirm? 1500, yes. Now, intra-group trading P to S. So who has earned the profit? Parent has earned the profit. So we have to reduce from parent, not from subsidiary. Parent to associate. No adjustment. Now, dividend. Dividend is received by parent company. So dividend would have been recorded in the books of parent company, not in the books of subsidiary company. Subsidiary company would have recorded the dividend paid in retained earnings, not in the P&L. So it doesn't impact the profitability of this one subsidiary. So nothing apart from this, nothing apart. So what are the adjusted profits? What are the adjusted profits? So adjusted profit is this plus this. Okay, now, so what is the share of NCI? What is share of NCI? So 15%, right? 15%. 15%, right? So is equals to this multiplied by 0.15. That comes to 31663. 31663. Is that correct, everyone? Is that correct, everyone? Now, so let us post it here. 31663. Okay. Now, let us further deal with this. Let us further deal with it. Though there is something related to finance cost which we have to discuss, but since I haven't discussed it relating to the finance cost as of now. Okay. Now the two things which are pending as of now is the share of profit of associate and the finance cost Now, first of all, I'll again discuss an easy stuff. Okay, that is a share of profit of associate. Share of profit of associate. Now, tell me, what is the profit the associate company has earned? 113050. 113050. Tell me, was the associate acquired in the mid of the year? Was the associate acquired in the mid of the year? No, so associate was not acquired. It was acquired on 1st June 2007, previous year, not acquired in the mid of the year. So we'll take the entire 35% of that into 0.35. That comes to how much? 39568. 39568. So what we'll do? Simple. We'll write here. Share of profit of associate amounting to 39568. And let's write here working note number. Let's write the working note number. So you write here working note 1, working note 2, and this will be working note 1. This will be working note 1. Okay. Sorted, everyone? Sorted? Share of profit of associate. So this is something that you need to be careful about. This is something which you need to be careful about. Now comes the treatment of finance costs. Now comes the treatment of finance costs. Okay. Working note number 3, finance cost. Working note number 3, finance costs. Now, what is the total finance cost of subsidiary? That is Roses. Why am I taking the finance cost of Roses? I'll discuss now. Don't worry. 13,000. So now the question says that the investment income of Pleasant Company includes $5 million interest income on a loan made to Roses on 1st April 2008. It means that if Pleasant Company is recording a finance income, meaning thereby Roses Company would have recorded a finance cost. Tell me yes or no. Now, the finance income recorded by the Pleasant Company, is there any adjustment required to be done to that? Is there any adjustment required to be done to that? Yes, we need to reverse it off because it's an intra-group. It's an intra-group. So let's reverse it off. So let's remove it. Finance income. So I will remove. We will remove minus how much? 5 million, right? So 5,000. How much? Which one? A3. Adjustment 3. So let us remove it from here. 5,000. Sorted. But are we required to do any adjustment to the finance cost of subsidiary company, that is Roses? Yes, we are required to remove. But what we do, this finance cost is for the entire year. So what we are doing? We are doing time adjustment for the finance for each of the P&L items of subsidiary company. But now what happens if we do time adjustment multiply by 9 by 12, meaning thereby this 5 million will also get time adjusted. But we know that this 5 million is entire post. We know that this 5 million is entirely post, right? This 5 million is entirely post. So if we do time adjustment, it will be wrong. So what we have to do is, first of all, we have to remove less intra group, not intra group, right here, let's write here, fully post finance costs, that is 5,000. Okay. Now, so this becomes how much? This plus this. Now this we have to do the time adjustment. So now we have to do what? We have to find out, we have to do the post adjustment. So now we have to find out of this how much is post acquisition finance costs. The post acquisition finance cost is this multiplied by 9 by 12. So what is the total post acquisition finance costs? What is total? So it is equal to this plus 5,000. This plus 5,000. Are you understanding this part, guys? Come on, tell me. Are you understanding this part? Now, what is the impact? See, if we would have done this entirely time adjustment, so we would have done this multiplied by 9 by 12. So we would have taken 9,750 in the post, but now we are taking 11,000 in the post, right? Are you understanding this part? So what is the impact of it? So it will, we are taking more finance cost. So it will reduce my profitability by this minus this is 1250. Okay, now we will deal with this point, but now this is the post acquisition finance cost. Now we have to reverse. What? We have to reverse what? Intra-group finance costs. What is the intra-group finance cost? 5,000. So let's do minus 5,000, which comes to what is the final finance cost that we will post in the P&L. This plus this is 6,000. So this is the amount that will go to P and L 6,000 finance cost. So you have to write it. We will not write 6,000. So you write here post acquisition finance cost. Okay, or you write your working note number 3. So we will write here. This part we will eliminate here. This part will eliminate here. This part will eliminate here. Rather, we will write here what 6,000 minus 6,000 minus 6,000 minus because it's an expense. So this is how you have to write. Tell me, is it clear now? Is the finance cost clear now, everyone? Is the finance cost clear? Tell me, guys. Okay, wonderful, wonderful. Now comes the allocation of profits to NCI. NCI. So what you need to be careful. See the post acquisition profits of roses. Tell me, is it correct? Is it correct? No. Why? Because it is considering finance cost as 9750, but ideally it should be how much? 11,000, right? So we need to reduce it. We need to reduce it. By what amount? So you have to write here. You have to write here this way. Adjustment of finance costs. Okay. Adjustment of finance costs of subsidy. Okay. Now, which is we have to reduce the profit by 1250. Now, are you understanding this part? So this is the very important adjustment which you need to be careful, 31476, 31476. So now here it will be equals to 31476 as the part for NCI. And now the amount that will go to owners of the parent will be total income minus 31476, that is 441133. 44133. Now, coming to but this is the allocation of the total company. But we need to show the total allocation of the profits and then this one. Okay, so how to do that? How to do that? So we have to show two allocation, not one. We have to show two allocations. So we have to show the allocation here also. Is the profits clear? Correct. So this is not added. So add it, no. 30 F, no, E31. E31. Correct, correct. So now we have to show allocation of profits. Copy, copy. Okay, now you have to show profits for the year. And here you have to write allocation of total comprehensive income. Total comprehensive income. So how to write now? And the amount of NCI will remain the same because there is no adjustment done which impacts the OCI, which impacts the other comprehensive income. So it will be the same. Okay, now this amount will be equals to profit for the year 509,377 minus this amount. That is, this is the amount. This is the answer. Okay, now and this amount is, I think, correct. Now is it correct, everyone? Tell me. Is it clear, everyone? Now let us just see that if we have covered each and every adjustments in our answer, and I will recommend all of you, whenever you think that you are done with your answer, specifically in the preparation of financial statements, okay, I will recommend all of you to go and watch and read the question once, just overview that if you have covered all the adjustments or not. Now see what how I will do. So first of all, this is the overview. Okay, fine, done. Format, we have covered everything. Now first adjustment is about fair value and its excess depreciation, which we have covered. Second adjustment is about since acquisition, Pleasant Company has sold goods to Roses, that is parent to subsidiary intragroup trading, which we have covered. Now the Pleasant Company has sold goods to Daisy Company, that is parent to associate intragroup trading, which we have covered. Okay, now what is the treatment? So parent to subsidiary, revenue decrease, cost of sales decrease, unrealized profit increase in the cost of sales. So which we have done. Now Pleasant Company has sold the goods to Daisy Company, unrealized profit treatment, in the parent cost of sales. We have already done, say 2359. We have already done that. So this is all sorted. Now the investment income of Pleasant Company include the dividend from Roses. Dividend from Roses, have we decreased? See, we have decreased 11050. We have already decreased. Right now. So this is also done. Roses paid a dividend of this much to this much. So we have already decreased this much part, but this part is pending now. Daisy Company paid a dividend of 29 million. So now tell me how much parent company would have received. So let us move on to adjustment number 4. Adjustment number 4. So now here, right here, what is the dividend received? Dividend, right here, dividend paid by associate Daisy. How much? How much? So it includes, it means it has how much? 29 million. 29 million. 29,000. 29,000. So now what is the amount dividend received by parent company? Dividend received by parent. What is dividend received by parent? So it is how much? It is how much? 29 ka 35%. 29,000 ka 35%. Okay, that is 0.35%. 0.35 will be yes. 10150. It is 10150. So what will we do? We will reduce the investment income by that amount. That is minus 10150A4. So we will reduce it. Minus 10150. 10150. So this decreases everything, and this my console P&L is sorted. Okay. This is the amount. This is the answer. Okay. Now, and this amount is, I think, correct. Now, is it correct, everyone? Tell me. Is it clear, everyone? Is it clear, everyone? Very good. So moving on to the next part. So this is the question of prepare the console P&L and other comprehensive income of the Pleasant Company. I believe it is very much clear to all of you. Now moving on to the next part. So it says on 1st April 20x. Okay, this is okay. Yes. So this question has the second part as well. Now in the second part, the question is asking you about sustainability reporting. All of you have watched my video on sustainability. Come on, guys, tell me. All of you have watched my video on sustainability? Not yet? Then please do that. So the question is saying the same question. Pleasant Company is a publicly listed manufacturer of food packaging materials. Pleasant Company has been implementing sustainable practices in its business operations and aims to further integrate sustainability into its business activities to address growing environmental concerns. However, the company is not yet familiar with IFRS Sustainability Standard 1 on general requirements for the disclosure of sustainability-related financial information. Provide a brief explanation about IFRS Standard 1 and the general requirements and disclosure of sustainability related financial information and its importance to Pleasant Company and stakeholders. It's a direct question for 3 marks. So I will recommend you to watch my video. I will recommend you to watch my video on sustainability reporting, and you will be able to frame the answer on that. So basically, you have to write three basic points that sustainability reporting is required so that the company can disclose the risks and the opportunities. Okay, the risk and the opportunities to the investors. Okay, it will lead to a transparent financial statements. Okay, it will increase the transparency, comparability. Okay, though the reporting under the sustainability standards are not mandated by by ISSB, but if the law of the country requires them to report, they have to do the reporting. Now there is a framework to report. How exactly you have to report? So basically, you have to say what is the governance structure, what are the strategies, what are the processes, what are the risk management. Okay, what are the targets, what are the matrices? So all those things are there. So I will recommend all of you to go and watch that video once. Okay, and definitely you will be able to write this answer in a very easy manner. Okay, I've covered each and everything in that video. Now, but yes, sustainability is an important topic for FR and SBR both for this attempt, and I have made up this video and already published the video in my YouTube channel. Okay, now coming to the next question. So it says, and the next question says, okay, the next question is Magnolia Company operates in a fashion and accessories industry. On 1st January 2007, Magnolia disposed of one of its subsidiaries, Pearl Company, for cash of $52 million. Pearl Company manufactures home decor items and was also sold because the Magnolia Group decided to focus on fashion and accessories sectors internationally. Okay, so basically the question is saying that the Magnolia Group was into the fashion and accessories department. Okay, now the Pearl Company, okay, one of its subsidiary was into home decor items, the furnitures, okay, or home decor like the, you can say, the art and the something like that. Okay, so the company wants to focus particularly on the fashion and the accessories and wants to sell and dispose of these decor items. Okay, so that it can focus, one say, on the fashion and accessories sectors internationally. It is the law of the nature. So if you focus on two different things, if you focus on two different sectors, okay, you won't be able to master any of the sectors. Okay, you won't be able to master any of the sectors. Now, so always, here also the question is trying to say the same thing. Now, the extracts from the console financial statements of Magnolia Group for the years ended 31st December 2006 and 2007 are as follows. Statement of profit and loss is given for Magnolia Company. Okay, now the statement of financial position is given. Now the inventories is given, the cash is given, the non-current liabilities is given. Finally, the question says the accounting manager didn't account for the Pearl Company's discontinued operation. Okay, the accounting manager didn't accounted for it as an discontinued operation. Might be is unaware of the things. Might be the accounting manager don't know the accounting treatment. Okay, now it says, as the division was sold, no information from the Pearl Company has been included in 2007 financial statements extracts above. The proceeds from the disposal has been recorded in cash. The proceeds was recorded in cash, correct? While all net assets and goodwill has been de-recognized, okay, the accounting team is confused on the accounting treatment of the balancing figure. So the balancing figure is the gain or loss on disposal, which is accounted for in console P&L, right? Now, the Magnolia Company acquired 100% of the Pearl Company, and the data is given for that. Moved its accessories, raw materials, and other data is given. Now, what is the question asking for? The question asking calculate the gain on the disposal of the Pearl Company that would be included in the console P&L of the Magnolia Group for the year ended 31st December 2007. So, what is the gain or loss on disposal? So, how do we calculate gain or loss on disposal? Tell me. First of all, tell me, was it a 100% subsidiary? If the question is not specifying anything, so I'll, yes, 100% subsidiary, right? So now, so how to calculate gain or loss on disposal? So for that, we need sale proceeds. We need sale proceeds. Now, then we need what? We need what? Less. We need net assets on disposal. We need net assets on disposal. Since there is no NCI, so we'll not write NCI. We'll need goodwill on disposal. This is what we need, right? This is what we need, right? Now, what is the sale proceeds? Is it given in the question? The sale proceeds? Is the sale proceeds given in the question? So the question says we have yes. On 1st January 2007, at the beginning of the year itself, the subsidiary was disposed of for 52 million. So I'm writing the amount in thousand because the P&L is also prepared in thousand. So I'll prepare it in thousand. Sale proceeds is 52,000. Now, is the net assets on disposal given? Net assets given on disposal. So it says the net assets, yes, it is given as 40,000. It is given as 40,000. 40 million is 40,000. Now, sorry, net assets 40,000. This is control X, control P. Goodwill on disposal is given. So it says the goodwill on date of acquisition, was how much? Goodwill on date of acquisition was how much? 8 million, 8,000. So it says goodwill has been impaired by 30%. So what is the impairment? What is the impairment by 20x5? Not in the current year. Goodwill was impaired in the prior years by 30%. So this multiplied by 0.3 is 2040. So what is the goodwill on disposal date? So it is equals to this minus goodwill of 20, impairment of 2400, 5600. So it is 5600 is the goodwill now. So what is the amount of gain or loss on disposal? So it is equals to this minus sum this plus this. That is 6400. So this is the gain on disposal, which will be accounted for in console P&L, So that's what is the question asking. Calculate the gain on disposal of the PERN company that would be included in the console P&L of Magnolia Group for the year end 31st December 20x7. Is that clear, everyone? Come on, guys, tell me. Is that clear, everyone? Very good, very good. Now coming to the next part. So explain whether the disposal of Pearl company is likely to constitute a discontinued operation in detail accounting detail the correct accounting treatment. What will for 3 marks? For 3 marks. Okay. Now we have to find out whether it is a discontinued operation or not. So how to find out? So read the question. Disposed one of its subsidiaries. So if it is subsidiary, we generally assume it to be a discontinued operation. But let's see. So it says it's a major home decor items. Now, what was the revenue from that? Is it given? Revenue from Pearl companies which is disposed at 45,800, 42,000. And what is the revenue from the group? 114. So it is a major segment, right? So right here, since revenue of Pearl company forms constitutes on an average of around how much? Just check. 20x6, 42,200 divided by 145,900. 28.92 means 29%, around 29% in 20x6. Okay. Meaning thereby it forms a major line of business, and hence a discontinued operation. Now, what is accounting treatment? If a segment is classified as a discontinued operation, then in P&L, entity needs to report a single line item stating post tax profit or loss. Okay. Disclose the details of the single line item in notes to accounts. Done. Details of single item is the revenue, the cost of sales, the gross profit, operating expense, profit from operations, finance cost, profit before tax, tax expense, profit after tax. Everything has to be reported in the notes to accounts, So it's for 3 marks. So I've written fairly for 3 marks. Makes sense. Now moving on to the next part. Comes the next part is about the ratios. The next part is about the ratios. Now, how to calculate these ratios? The gross profit margin. So let us calculate the ratios now. GP margin, then comes OP margin, then comes interest cover, then comes inventory turnover days. Inventory turnover days. Now, can you calculate these ratios on your own? So like GP margin, it will be equals to how much? Tell me. GP by revenue. Tell me. Wait a minute. GP by revenue, right? Can you do that? Operating margin, operating profit by revenue. Can you do that? Interest cover, profit from operations by finance cost. Can you do that? Inventory turnover. So what is the inventory turnover? What is the inventory turnover formula? Tell me guys, come on. What is the inventory turnover formula? Because these three you can easily manage. Tell me the inventory turnover formula. Inventory by cost of sales into 365. So with that you can calculate the inventory turnover as well. So you can calculate these ratios on your own. You can calculate these ratios on your own. Now, how to now moving on to the next part for 4 marks. So this question is an amazing one, yaar. Initially, this question gave you 2 marks for gain on disposal, 3 marks for this one. 2 marks for gain on disposal, 3 marks for commenting on this one. 2 plus 3, 5. 5 plus 4 marks on ratios. 5 plus 4, 9 marks. So free may given, right? 9 marks free may given. Now coming to the next part, the commentary part. The commentary part is for 11 marks. The commentary part is for 11 marks. Now this is called as the interpretation of financial statements. Guys, I will recommend you that if you have not watched my video on interpretation, please do watch it. In that video, I have discussed what to do and what not to do in the interpretation question. So please, if you have not watched that video, do make sure that you are watching that video. Make sure that you're watching that video. Okay, now further. Ishita, don't do that. Okay, now make sure that you are watching that video. The next part is in that video, I've also discussed the technical article on interpretation, everything. Okay, what are the mistakes which you can do and which you cannot do? Okay, now coming to this question, analyze the performance and the position of Magnolia Group. So now how will you write? So first of all, you have to write your answer in 3 parts: performance, then position, and then conclusion. Now, so conclusion, you can score very good 2 marks, 11 marks. So 2 marks gone here. So 9 marks. So 5, either 4 or 5, 4 to 5 here, 4 to 5 here. So I'm writing here 5. I'm writing here 5. I'm writing here 5. So you have to comment. Now, what you have to comment? So in performance, you have to comment on revenue. So now what happened? See, the revenue has decreased from 20x6 to 20x7. The revenue has decreased. Now, if you say that the revenue has decreased, why? Why? Because of, tell me what? Tell me why? Disposal. Very good. So the revenue has decreased. Then you have to comment on GP margin. Then you have to comment on GP margin. Then you have to comment on operating profit margin. Then you have to comment on operating profit margin. Then you have to comment on interest cover. Then you have to comment on interest cover. Okay. Now, if you calculate the ratios, you will find out the GP margin, the operating profit margin are increasing. Okay, this GP margin and operating profit margin are increasing. Now, how will you justify? So first justification is GP margin is increasing after disposal, meaning thereby it was a good decision to dispose of, right? It was a good decision to dispose of the subsidiary and focus on the core division of the fashion and accessories. So after disposing of the home decor items, division, the entity is able to focus more on the fashion and increase its profitability. This is one of the reason. Now, always remember, whenever you are writing the answer on interpretation, never write a close-ended answer. What is the meaning of a close-ended answer? Meaning thereby you write the reason for this is this. You cannot conclude that this is the only reason. So you have to write this possibly could be the reason. This can be the reason. Either this or this can be the reason. So don't write that this is the reason, right? This could be the reason. Okay. Now, further, you have to comment GP margin has increased, operating profit margin has increased. Now, what you will write? See, read these points. So it says Magnolia Group has moved its accessories division to a building owned by the group, but before disposal, this building was in use for Pearl Company. So basically, might be a Magnolia Group had a building which was ideally used by the Pearl Company, but now I have disposed of Pearl Company, so that building has become vacant. Now what I'm doing is I will occupy that building. I will occupy that building. Previously, accessories division used external facilities on lease. So basically, when Pearl Company was with me, my office was taken on lease. I had my own building, but I gave that building to Pearl Company to use it. But since there is no more Pearl Company, I will occupy my own building, right? Why will I take a building on lease? So it will save on my lease costs. It will save on my lease costs, right? So you have to include this point. You have to include this point that saving of lease costs, in future. It's a future saving in future. Now, further, at 1st January 2007, Magnolia Group terminated the lease with one-off payment. So now it is no more future. It will be start from present year itself. Magnolia Group of $3 million per annum. Okay, Magnolia Group terminated the lease with one-off payment, and this payment was recorded in operating expenses. How much? 4 million. So now penalty. So when you terminate the lease, you have to pay a penalty of $4 million. But this is a one-off event, one-off expenditure incurred in current year. This would have increased your operating expense, which would have decreased your operating profit, meaning thereby in the current year, after sale, my operating profit is ideally increasing. But it would have decreased because of this one, meaning thereby in the years to come, my operating profit will further increase. In the years to come, my operating profit will further increase. Now it says Magnolia Group imports raw materials from overseas. Foreign exchange gains of this much is recorded in 2006. In the previous year, we have recorded gains. In the current year, we have recorded forex loss of $2 million, meaning thereby I do have an exposure to foreign exchange risk. Exposure to forex risk. I do have an exposure to forex risk. Okay. Now interest cover. So you have to write here according to the interest cover ratio. What need we need to do what if analysis in this or not? In this case, what if analysis is not required. In this case, what if analysis is not required. Just a theoretical comment on what if analysis. Yes, you can do that. But calculating everything and doing it off doesn't make sense. Okay. Because you don't know how exact is the impact. What exactly is the impact of this one? Okay. Because see, understand, penalty is an often one-off expenditure which will reduce my current year's profitability. Lease costs will basically would have is a saving of the lease cost. Again, it will increase my profitability. So basically there are multiple things coming in here. Right? So what if analysis you will do? If there is one particular item which has impacted significantly a particular line item, then yes, in that case we do need to show what if analysis, that what if this item is not there, then what would have been the scenario, right? So but in this case there are small minute multiple details, right? See, 4 million means what? 4,000. And see, what is the profitability? 35,000. So this is not even 10%, right? This is not even 10%. So that's why 10% of total expenditure, right? So it will not have a major impact. Now if you do 4,000 out of 1 lakh 1,14,000, so how much it is, right? 4,000 divided by 114,800. It is not even 3.5%. It is just 3.5%. So it won't have major impact. So what if analysis won't be of much help here in this case. Okay. Though even if you want to do, you are welcome, but it won't be of much help. Further, you will also write gain on disposal will also be there. Gain on disposal will also be there. Gain on disposal will also be there. Right? Gain on disposal. So this gain would have also increased my profitability. Now you're understanding. Now you're understanding. So gain on disposal would have increased my profitability. Forex loss would have decreased my profitability. Forex loss in the current year, right? Yes. Now, penalty would have decreased my profitability. Savings would have increased my profitability. So there are multiple things. If you do the net, now if you do the net, how much? So savings increases, savings in lease cost of 3 million. So it increases my profitability by 3 million. It increases my profitability by 3 million. Penalty will decrease my profitability by 4 million. Forex loss will decrease my profitability by 2%. Now, this gain on disposal was how much? 6.4 will increase by 6.4. So how much it is coming to? 3 plus 2, 3 plus 6, 9.4, 9 minus 6 is 3. So net impact is just 3. Net impact is just 3. Okay, so no point making that, no point making that, okay? No point making the what if analysis. So there are multiple small line items. So these are the reasons for increase or decrease of the this one. Gain or disposal will not come here. It will come here. Okay. Now interest cover, you can comment according to the ratio. Now position, in the position you have to write the cash proceeds from sale. What is the treatment? Might be the case that whatever cash proceeds we have received from the sale, whatever cash proceeds we have received from the sale, see the cash has increased. Cash has increased and liability has decreased, meaning thereby what? Whatever cash you have received from the sale, you have used it to repay your liabilities. Okay, you have used that to repay your liabilities, and further balance is standing in your cash balance. Okay, which increases your liquidity balances. Now, in the position, you can also write about non-current, link it to non-current liabilities. Then, in this case, further, what you can comment, is yes, your since you have exited from the lease contract, so no more lease liability, no more lease liability, right? No more lease liability. So that might also be the reason your non-current liability has decreased. That might also one of the reason. So this also you can write here. Now further, what you can write other is inventory holding. You can comment on inventory holding. You can comment on inventory holding as well, right? So 1, 2, 3, 4 points here. Now 1, 2, 3, 4, 5 and 6 points here. 6 plus 4 is 10. And now then you can conclude saying that the profitability has increased. So the company has focused more on its key sector by disposing of the non-core sector, and which is a good move. And in the years to come, we see the profitability increasing because there are many one-off events in the current year which will not be existing in the next years. Is that clear? So this is how you have to write the commentary on the performance and the position and the conclusion of it. Is that clear, everyone? Come on, guys. So that's all from my side. I wish all of you a best of luck for your examinations. Perform well. If you have any queries, try to reach out to me. Okay, you have my contact number. My contact number is +9185